The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Show. It's Monday morning already. How exciting, with Karen Cho, myself, Steve Sedgwick, and these headlines, of course. So the US introduces a $100,000 fee for H-1B work visas, sending US-based tech sector scrambling to respond and actually pushing the tech companies in India sharply lower in early trade. Elsewhere, the art of the deal, President Trump says he has an agreement with China to allow TikTok to continue operating in the United States, with the Oracle chairman Larry Ellison and media mogul Lachlan Murdoch set to be involved as investors.
Elsewhere, the UK, Portugal, Canada and Australia formally recognise a Palestinian state on the eve of the UN General Assembly as international pressure on Israel continues to mount. And in company news, Spanish lender BBVA ramps up its hostile takeover bid for smaller rival Sabadell, improving its offer despite previously saying it wouldn't sweeten the deal.
Good morning, how are you?
Good morning, very well, thank you.
Good. Did you have a lovely weekend?
I did. It was very busy. Not as busy as some other people, though, I think. Turning planes around, ordering captains to get back to the ground immediately so they could deplane to get ahead of visas.
You're about the visas.
Something like a bad Netflix plot that was really playing out stateside.
I mean, the utter confusion. Look, I understand elements of what the politics. Let's go into it, whatever. We'll do this in a moment. But I get it. But confusing everybody with whether it applies to existing or future or the next tranche of visas from February onwards as well, and what the carve-outs look like. Utter confusion. The policy itself, I can understand some of the logic behind it, even if Elon Musk hates it as well. But the confusion, if you're gonna tell people that there's a massive change to the kind of workers you can have in your country, well then make it clear what the rules are. Don't have one official saying one thing on Friday and then your press secretary saying something else over the weekend. Utter confusion.
Yeah, a scramble for high-end talent too. Don't forget this type of era that we're in around AI and the scramble for highly prized technology talent. That's part of the mix at this stage, and it's not just coming from the United States. It is coming from advanced markets like India and China that have been on the forefront of AI. So I think what you're seeing has been fairly disruptive to the space, from banks to technology companies that were demanding their staff come back, consultancies too.
So look, this is a golden, not visa, but golden gift to other countries. Because let us be brutally honest about it. And I spoke to a gentleman for a series I'm building, and he could have gone to Silicon Valley, but he stayed in Europe as well for all kinds of reasons, and I'll come to that in the series I'm doing. But the fact of the matter is, there's no doubt about it. If you are a tech whiz kid, a brilliant engineer that you were talking about, you want to get to the States. That's where the big money is. That's where the big opportunities are. That's where the ecosystem is, by and large. I know that that's a very blunt statement, but by and large, if you're that individual, you want to get to the States because that's where your talents will probably be most appreciated as well. But for the government to make it more difficult for the companies who want to hire you to get you there as well, what an amazing opportunity for the rest of the world to level the playing field.
Is it a money grab? I mean, are these sort of people that American companies have to hire anyway to increase productivity? So is it just an extra expense for business, number one? Number two, to your other point around it is an opportunity for others. Did you see that the UK is now looking at scrapping the visa for anyone who's won some sort of university prize, has some sort of amazing university degree? It sounds like you have to be best of best, but still,
we should have them anyway.
Sounds like it'd be free.
I mean, why do we have barriers for these brilliant international students and engineers and people have you? Anyway, it's great. I don't think it's just about the money, by the way. I think it's about appealing to the base as well. And let us be honest, there are hundreds of thousands, tens of thousands of brilliant American graduates coming out of university who are perhaps finding it quite difficult. And so this would actually appeal to the base as well. But so much more to discuss. We will keep this story going because we're fascinated by it. Other stories as well. But I'll give you a bit more detail. The president has announced plans to impose a fee of $100,000 for new applicants for the H-1B visa. As long as we know it is the new applicants, because There has been a bit of a confusion, hasn't there? Anyway, in a move that could deal a blow to companies that rely heavily on those skilled workers from overseas. US Commerce Secretary Howard Lutnick called on companies to train up recent graduates from American universities instead of importing talent. That's the kind of point, isn't it? The fee will apply, though, to new applicants for the visa, not renewals, apparently. And will first apply in the upcoming lottery cycle. India will see the biggest impact from the implementation of the fees. Its citizens received the highest proportion of H-1B visas in 2024, accounting for 71%. Chinese citizens received almost 12% of the overall number. Amazon has been the biggest recipient of the visa this year, with more than 14,000 awarded in the first 3 quarters of the year. Next is Tata, with US tech giants Microsoft, Meta, Apple and Google rounding out the top 6. CNBC has reached out to all the public companies on the top 10 H-1B visa recipient list for comment.
Other countries have been quick to jump on the uncertainty, with China announcing a new K visa aimed at attracting global talent in sectors including science, technology, engineering and mathematics. It's set to come into effect from the 1st of October. Meanwhile, the UK government is reportedly considering removing some visa fees for highly skilled workers. The Financial Times says the Prime Minister's Global Talent Task Force is working on policies that could help draw in some of the world's top talent. And a quick look at the reaction we're seeing across on markets. India, where you're seeing some of these major companies that rely on some of those visas. In the United States, those stocks are weaker, like so Tata reversing. You've got Tech Mahindra sliding. Elsewhere, you see Infosys too, and Wipro under some pressure. I
have one slightly different angle, and I'm sure you'll want to comment on this one as well. I have never heard, I love it when I hear new stuff. I hear so much herd thinking from a lot of commentators out there. Little tech.
Little tech? What's little tech?
Exactly. We talk about big tech the whole time. Big tech, big tech. But you can't move from CNBC without the swamp of big tech and the Mag 7 or what have you. Little tech. And one of
these are not big tech yet?
Well, maybe never, but these are the companies who are really going to suffer. And there's a lot of little tech in the United States that rely on these amazing people to grow and to become and to prosper and maybe one day become medium-sized tech. But I think that was a really interesting thing. I've never heard the term, and it's such a simple term, and it really matters. Little tech could be the ones that really suffer, because big tech, let's be honest about it, they're rich, they may get their waivers, they'll get there somehow. But it's little tech that could suffer in the United States.
Yeah, I was interested to hear that Netflix was behind some of these measures, the changes to the visa system, which was interesting, which made me think, well, why are they? And there is, I guess, some talk as to whether this is another immigration curb or whether it's a reform of the immigration system. And the reality, if you dig into the detail around these visas, again, the lottery system had to revise as to what the lottery system was, but there's a cap of these regular visas, 65,000 each year is where the cap is.
Netflix
and then
20,000
for applicants with advanced degrees. So that's the number. The rest, basically, there's a lottery system here because those registrations exceed that number regularly. So instead of it being a process where you say, who do we need on the ground? What are the most useful talent? Those are the people that get given a visa. It becomes a lottery system of those that may or may not want to go into the US. So therefore, if you're a Netflix...
I don't understand why Netflix...
Well, therefore, if you're a Netflix and you want to hire top talent, it's only if that person gets accepted in a lottery that person will be allowed into the United States. So they may or may not be able to be hired. So if you want the talent, you should be able to hire the talent for a certain price maybe as well.
Well,
so
guess what?
Here's
something else as well. Hollywood is floundering. Hate to say it, because, you know, I'm a massive film buff, as you know. Hollywood is floundering. You can make this stuff all over the world. If the likes of Netflix, who are one of the biggest production companies on the planet now, and other big studios are having higher costs to build their production, their amazing output in the United States, they are going to make this stuff elsewhere. They're going to come to the UK, they're going to go to India, they're going to go to Eastern Europe, they're going to go to all over the other places which are proliferating on the production company front.
This was the line from Chairman Reed Hastings, who was saying in a post that it will eliminate the need for the lottery and provide more certainty for those who get the H-1B visas. And don't forget, in the devil in the detail overnight, there was you could petition as well for these visa fees to be waived. So is there access for the likes of Netflix and others?
Why would you... I don't understand the Netflix argument.
Yeah, certainty, I guess, is what they're looking for. What we've got out of the US markets, let's take a look at some of the action we saw stateside Friday. Again, more positive numbers, fresh records inked in that intraday session. You can see on the Dow as it finished higher, we certainly had fresh gains. Fresh all-time high, fresh record close by the end of the session. Over the course of the trading week, a bounce of about 1%. For the other major boards, even firmer, 1.2 on the S&P 500 for the trading week and 2.2 for the Nasdaq over the course of that week. So very much a story around tech leadership again, and it was semiconductors part of the mix too. Asian markets picking up on some of the Visa story morning session, and this is how we look across the board. We've got the Chinese market, Hong Kong market reversing. Some concerns about bubble-like territory you may be seeing in some of these tech stocks in the Chinese market. So just a bit of a pullback transpiring today versus green on the Nikkei 225, and the Kospi also perched high for the Monday session. To European markets and how we're looking to start out the trading session today, this is the early picture. We're looking a little bit soft. The early indications for the FTSE 100 slippage of almost 0.2% last week. Similar tune, that's where we closed up shop Friday, down just over 0.1%. For the trading week, also in the red. And you saw that across most of the major European markets last week in the opposite direction from US boards. Interesting to note, the French market was one of the exceptions. There's been some nibbling around some of those big luxury names. So we're going to be talking a bit about Burberry this morning as well in the UK market. Now, US futures, the early indications of the picture for Wall Street this morning, it does look cautious at this hour. So a few more clues perhaps investors are searching for on the inflation side, PCE later this week. And of course, don't forget fresh records, a little bit of caution ahead of that session.
So as Karen mentioned, PCE on Friday is the big print as well. The inflation gauge, which is the preferred one from the Fed, for clues on the rate path ahead. Expectations are for 2.8% rise on the year, with anything higher possibly sparking concerns that last week's rate cut may have been premature. Speaking to our US colleagues, new Fed Governor Stephen Myron gave his take on whether tariffs might be driving prices higher. What do you think he said, everyone?
I don't see any material inflation from tariffs. I see no evidence that it's occurred. In my opinion, if you look at import-intensive core goods, they've inflated at no faster a rate than overall core goods, which is not what you would expect to see if you thought tariffs were driving inflation higher. You'd think imports would be differentially inflating at a higher pace.
Yeah, I'm shocked. I thought he'd say it was inflationary. I jest, everyone, all right? Okay. Our next guest says the global economy is showing signs of stress and the AI trade could fizzle as the free cash flow of hyperscalers continue to dwindle. Peter Berezin is the Chief Global Investment Strategist of BCA Research, and we're lucky to have him because he's probably quite tired from his flight over the Atlantic. Good to see you, Peter. How are you, sir?
I'm doing very well, thank you.
So look, I've got a bone to pick with you. You may well have cut out some of our audience because one of the key points you're making here is, do we need to keep our finger near the eject button for the markets? I don't even think millennials know what an eject button is, because I was thinking about it. I was thinking, can you remember the buttons on a tape recorder? It was record, play, rewind, fast forward, stop, and eject. I don't know if millennials even know what an eject button is, but they probably get the metaphor anyway.
Yeah, well, I think, basically since 2008, if you had bought the dip, you had done the right thing. And so people are conditioned to buy the dip. And so if we start to get some real stress, it might take a while before that translates into a bear market, but eventually I suspect it will.
I've got to say that what you're suggesting about being a little bit cautious, maybe thinking about capturing some of those paper profits to date, makes sense after the conversations I was having last week at the Bank of America conference, where some of the big money was really cautious about risk levels. So to that point, even if you like the AI trade and you see it going a long way from here, we're in the foothills of some of these big changes, the big innovation we're seeing from AI, does it make sense to be a bit more tactical? Is that the way to play it? Think about capturing some of the profits so far and getting back into the trade at another stage?
Yeah, I think at some point the music will end. We don't know when. So if you're tactical, put in a stop loss and just wait. If you have a longer term horizon, I think it does make sense to start taking profits here because the economy isn't really on that firm ground. And the AI trade, I suspect, will begin to fizzle as it becomes clear that the profitability of some of this AI technologies may not materialize anytime soon.
What jumps out to me every time we cover the story is that there are a lot of applications now for AI. And there are a lot of other pieces, not just the picks and shovels or the hyperscalers. The picks and shovels, of course, being NVIDIA, hyperscalers being the likes of Amazon, Microsoft, and everybody else in that space. But is the money just going to go elsewhere? And I'll cite, for instance, last week, clean energy was having a great run. I mean, the clean energy utility story, empowering AI, is a huge theme, and the application part is too. So if there is a wake-up call that the valuations are too stretched and the early movers in AI, could it move to other areas where investors are still just putting the feelers out in terms of how those returns will look?
I think the risk is that AI stocks, broadly defined, are about 1/3 of the S&P 500 right now. So if you get a meaningful pullback in those names, a lot of the wealth that people think they have, the paper wealth, is going to disappear. And that's going to have a knock-on effect to the economy. Consumer spending will slow, investment spending will slow. And so if the economy begins to weaken, if unemployment rises, then all of the sectors in the stock market are probably going to go down.
So, Peter, and that's interesting, despite the fact that so many of our guests over the last, let's say the last year, or certainly this year, have told us the key is diversification here as well. Diversification away from just that concentration on Mag 7 and AI-related trades. They failed, yeah? They failed to meaningfully diversify. And I see it all the time, by the way. I look at the portfolios of my pension, and I'm like, oh, yeah, same old stuff. Oh, God, yeah. Higher weighting US, higher weighting tech within that as well. It's the same old story. So they failed, yeah?
They failed, yes. The question is whether they'll continue to fail. I mean, you could have said the same thing in the late 1990s. Dot-coms was where you want it to be until that's not where you want it to be. So I think it does make sense to have a diversified portfolio prospectively, because you don't know what's going to happen to the economy.
What does diversification? Sorry, Peter, to interrupt. What does it look like?
I think diversification across different equity sectors, across different asset classes, across different regions, owning some historically defensive assets such as gold, basically a broad-based portfolio.
Yeah, I have a problem with gold and silver. They just raced away, though. I mean, I don't know. You go back a couple of months and the copy says, will silver meaningfully break above $30 and now it's like $42 or wherever it is, and it's like it's gone. Gold, will it meaningfully break above 3,000? Now it's 3,700. It's gone as well. Can we still invest in those diversifiers, those precious assets, those safe havens without getting burnt?
I mean, as a share of overall global wealth, gold was around 10% in the early 1980s. Now it's about 3%. Yeah. So if people want to hold as much gold relative to their other assets as they did back then, there's still upside for gold prices. But I agree with you. Gold has had a phenomenal run. Probably you're going to get a bit of a pullback before you go higher.
Can I ask a broader question around the US economy? Because there is a view that there's a run at hot theme taking place stateside with the tax changes coming from Trump, deregulation. That's another big theme for the markets. And even if we've got fresh records, do you think parts of the market are overvalued, particularly around AI, that there could be more to come? Do you think there could be other sectors to benefit from a Trump trade?
My guess is that the benefits of the tax legislation are going to be dwarfed by the negative impact from tariffs. Even though, as we were listening to that clip from Stephen Moran, he says that there's no inflation. The reality is that inflation has picked up from around 2.3% to 2.9%. If you look at the CPI swap market, we're probably going to have inflation of around 3.5% by the middle of next year. Nominal wage growth is quite weak. Fewer people are working outside of sectors such as healthcare. Wages are not growing as quickly as they were before. If you have higher inflation, real incomes are going to stagnate, and that's going to hurt consumption, which is 70% of the economy. In that sort of environment, I don't see the stock market continuing to make new highs.
Peter, final question from me. In terms of the role that the bond markets play in terms of your diversification, your safe haven as well, we are privileged to have so many bright minds come through this desk and tell us the bond market is a safe haven and the yield on the longer end is fantastic opportunity, or isn't, and the steepener continues because of the fiscal woes of so many countries. But what do you think about that longer end?
I think longer term, I would be quite worried about the long end of the curve, because we do have an unsustainable fiscal situation in the US, a budget deficit that's already 7% of GDP, probably going to be close to 8% next year, could be 10% if the economy falters and goes into a recession. But tactically, if the growth numbers begin to surprise the downside, I would expect yields to go down, at least temporarily.
So it's amazing. You've got the recession, good for bonds because obviously there's less inflationary impetus, you're going to get interest rate cuts, but bad because the cause of the recession as well include the fact that this is a government which has less firepower to support because of its fiscal woes.
And normally when an economy enters a slowdown, bond yields fall, fiscal policy turns more stimulative. There's not a lot of scope for fiscal policy to turn more stimulative, given how large the budget deficit currently is.
Yeah, the tap's already open. Peter, thank you very much for joining us. Peter Berezin with us, Chief Global Investment Strategist, BCA Research. Coming up on the show, Burberry is set to rejoin the FTSE 100 in a stylish comeback for the British luxury brand. More details next. Plus, President Trump touts a deal over TikTok with his Chinese counterpart Xi Jinping. We'll have more this hour. And don't miss our interview with Palantir's Executive Vice President for the UK and Europe. That is coming up at 9:30 BST. British luxury brand Burberry will return to the FTSE 100 index today, a year after its removal from the index after a 15-year run. Burberry's return was announced earlier this year after a stock price rebound as it looks to execute its turnaround plan. Well, Charlotte joins us with more. Charlotte, I was pondering this earlier. I know that the luxury sector is being raked over again by a lot of the analysts. I'm not sure why, because I don't really think any of the dynamics have picked up on the ground in China at all with that consumer. But nonetheless, the analysts are looking at it, and if everybody's underweight, could be a good time for the FTSE 100 to take back on board the Burberry stock.
Yeah, absolutely. And that was always the issue for Burberry as well, trying to do this kind of turnaround while there was a slowdown in luxury overall. So it's a bit of a double challenge there for the British luxury brand, but certainly re-entering the FTSE today. So symbolic and kind of the next chapter in this turnaround has been that we've seen playing out in the past year after the CEO Joshua Schulman joined back in July last year. He was at Coors and Coach before that. And that was after Burberry had issued multiple profit warnings. They sent the shares diving, which meant that then Burberry was out of the FTSE 100 in September last year. And like in November last year, Schulman presented his Burberry Forward strategic plan, talking about the focus on outerwear, the trenches, the scarves being the strength of the brand, and also reviewing the pricing structure. And that was a key element there where previous management had pushed up the prices quite aggressively, kind of leaving behind also with the aesthetic some of their core customers. And instead they want to refocus on the core customers and have a more diversified pricing structure. They also looked at revamping the stores and optimizing things, and they also included some layoffs there. So since then, they had some savvy campaigns that have been quite successful online, including with the Oasis frontman over the summer. That was called a festival campaign. They had some TikTok influencers being involved. They had a bit of a buzz recently, and that's been working quite well. And overall, investors are seeing quite positively the turnaround, the first move of the turnaround, and looking at the like-for-like sales at Burberry. They have been improving quite dramatically over the past few quarters. Now, we're still negative. That is important. The last results in July were still down 1% year on year. But the trend has been very, very positive because a year before that, they were down 20%. So there's some hopes that maybe at the next earnings in November, we might see a positive sales there in the quarter. But that is the challenge here, is that we are now in the next phase of the turnaround for Burberry. And that was in a sense what the Erwan Rambourg, the global head of luxury and consumers at HSBC, said to us last week.
And when we upgraded Burberry, it was a bit controversial. Now it's not as much. It's more widespread, but I still think there are good times ahead. And essentially what's going to move the needle now is the reality of important product launches, whereas before it was more around merchandising tweaks, media campaigns, rather than actual products that move the needle in terms of the turnover.
So it's about new products now, because while they did a bit of a tidying up of the business for the past year, now it's really about new products and new visions. So they have the show tonight for the closing the London Fashion Week, where we're kind of testing the revival a little bit of the brand. And now it's the all-important holiday season. We know this is the most important one for Burberry, the autumn-winter one. So that's when we will see whether that turnaround is really happening. But certainly we've seen the shares having this ride, a really strong recovery for the past year, and now allowing Burberry to re-enter the FTSE today.
Can I be stunningly unpatriotic? Good morning to you. How are you? That wasn't my unpatriotic bit. Why would I buy Burberry on 38 times forward when there are some titanic mega names out there trading significantly lower in terms of their forward PE. And I'll just mention the daddy or the mummy or the maman or whatever you want to call it, or the mutti if I'm going German. LVMH, 22 times forward. Burberry trades on 38 times forward. Why on earth would I go shopping for a company that sells Macintoshes and is trading on 38 times forward?
Well, for a lot of people to say actually the trend going forward might be more positive for Burberry. There's more recovery potential for Burberry than some of these big players. They're still suffering as well. They have seen their sales being hit as well. And you were talking a bit earlier how we don't see just yet a recovery from the luxury buyers, whether it's Gen Zs or the Chinese buyers. Some of the key demographics are so important to the luxury sector. They're not coming back just yet. And so see for Burberry, because it comes from so far back, because it's in that recovery mode, there might actually be more places for them to go up as well.
Can I reshape your question, because I think it is the right question if you would buy another stock in the sector. I think LVMH, you get the drinks business, and that's not been going so well for them, so you get that bundled up. But perhaps the question is, why wouldn't you buy Kering? I mean, it's a great question. Are there other, or would you buy Richemont? I mean, if you start thinking about the other valuations in the sector, there is
Kering
a would I buy something
the next
else?
one. That's why people are watching very closely. You know, Luca De Meo joined just last week. He's named a new CEO at Gucci, so that could be the next turnaround story. But we haven't seen the tangible signs just yet that turnaround is happening. While at Burberry, we have seen the numbers improve every quarter. So there are some very clear signs that it is happening.
Well, Charlotte, all eyes on London Fashion Week. As you mentioned, it will conclude today with Burberry launching its latest collection. Tanya asked British Fashion Council Chair, or CEO rather, Laura Weir, about the importance of the company to the industry.
Burberry's story with British fashion is probably one of our most brilliant love stories. You know, they're completely intertwined, and to have them at London Fashion Week is essential to our programming, and they really are a key partner when it comes to exposing the best of British fashion during the week. Of course, the luxury sector is challenged, but I think I'm not alone in feeling like Daniel's work at Burberry and Josh and the team there are really driving forward a new vision for the brand, which I think is really exciting and working brilliantly.